So it's a minute or two after 2 o'clock, so let's go ahead and get started. I can tell this is going to be a great session already. We've got one comment in chat. What recession? We have more job openings than we had 6 months ago on the eastern shore of Maryland. So glad to hear that, Dan, and we'll be addressing that, why we think there is a recession coming. So as background, you have 3 speakers today. Myself, Chris Chmura. I'm the CEO and Chief Economist at Chmura. I'll be talking about the broad overall economy, followed by Patrick Clapp, who will be talking more about job postings and what they say about the upcoming economy and employment and hiring. And we're very happy. And by the way, Patrick's been with us almost 10 years as an economist, and we're very happy to have with us presenting Heather Blair from LHH. She's going to give us the boots on the ground view, and you all probably know LHH has a staffing services firm as well as temporary and permanent placement. I really liked Heather's LinkedIn profile. She said, "My kids tell me I make friends and help people get jobs." So Heather, we're happy to have you and look forward to your comments about how things are happening real time in terms of hiring. So with that, let me just give you some background on Chmura. If you don't know us, we provide labor market data and analysis to help your firms and communities and individuals thrive. We were founded in 1998 with offices in Richmond and in Cleveland, Ohio. We're a little bit over 50 economists, data scientists, statisticians, and business professionals who really care about helping you grow your community and your business. If you've ever worked with us, you know we're driven by client satisfaction and success. We have a consulting side as well as the Jobseeker software side, which has a long roadmap of items that we're always adding to help you be more efficient. And really, bottom line, our top priority is really to be excellent in the customer service and the data quality that we provide to you in both our consulting and on the services side, on the software services side. And along those lines, we've been producing this weekly economic update for many years. It comes out every weekend and gives you an overview of the numbers that came out last week, what some of the highlights were if the Fed spoke, and if that has implications for monetary policy, and then some of the financial indicators and a forecast. And you're welcome to sign up for it. It's complimentary. You could click here or go to our website, Chmura.com, and all the way at the bottom of the first page, you can see where you can sign up for it. And so before we begin, Heather, if you would like to take a few minutes to tell us about LHH.
Yeah, that'd be wonderful. Thank you. So LHH is an end-to-end talent solutions brand. We're a global organization, and we set up our business model so that we can address the needs for both employer and job seeker in every part of their talent journey. So we want to help organizations build their capabilities and individuals build brighter futures for themselves. I represent our LHH Recruitment Solutions brand, and we have specialized consultants across every professional industry in 29 global markets. And the way we're set up is our local expertise. We pair our local expertise with a globally collaborative approach to deliver the right talent with the skills needed for today and in the future.
Great. Thanks, Heather. So with that, let's go on. So bottom line, what does the potential recession mean to employers? We're on the cusp of shifting from an employee to an employer's market right now. Clearly, the momentum has changed. And even though the job postings are up on the Eastern Shore, as they are in many places around the U.S., you're probably seeing some change in momentum. And it's not as quick as an on-off switch, but the ability to hire has improved, but it's still a tough labor market. The number of candidates, as we see the unemployment rate go up and unemployment claims go up, we're going to eventually see the number of candidates available increasing with layoffs. Quits are dropping, and that's data that just came out yesterday. We'll take a look at that. So people are not leaving your organization as much, and so that's a positive, at least, even though it's still hard to get new people to join. We did see a pretty good sharp uptick in wages late last year. We're seeing that uptick slowing, but we're still seeing wages growing at a faster pace than we saw in the last couple of decades, and at a pace, unfortunately, that is slower than the rate of inflation. Especially when we get to Patrick's side, you're going to see that not all industries and occupations are affected the same way. That's very clear in the job postings. And so now to hit on Dan's question, why do we expect a recession? So it's all revolves around the Fed's goal of bringing inflation back down to 2%. And here you can see from the Consumer Price Index, total overall inflation year over year peaked out around 8%, above 8%, and now it has slowed to a little bit above 6%. That's still much too high. It's too high for the Fed in terms of their 2% goal. That's something that we saw over the last decade. But when we went, this gray shaded area is a recession. When we went into the COVID recession, you saw that prices went down, especially on the goods side, because we couldn't go out and spend. Prices went down on the services side. And so because we couldn't go out and spend, we couldn't go to restaurants or other things, we purchased a lot of goods. For example, we couldn't go to the spa, so we purchased the Peloton. And that caused those prices to go up. And then once we got to the point where we were able to get out and we really wanted to go out and spend some money in terms of going back and getting our haircut or going to hotels, you can see the price of services started to go up. So right now, year over year, we're looking still at goods prices up about 4% from a year ago, but services prices are not coming down. Why is inflation bad for the economy? It's a regressive tax. So it hits people, the lower income earners. So for employers, you may be finding that your lowest paid workers are those that are having to get the biggest increase right now because they can't afford to go out and purchase the organic food that they did in the past. They can't even take vacations because of the price of gas going up so much. And so that increase in inflation is hurting the people who make the lowest incomes, which is why we have actually seen a jump in their pay more so than people making more money. It also distorts decision making, and that can lead to longer recessions. So if we're in a period of time where we're seeing prices go up significantly, let's say you're a commercial builder and the price of steel is going up 60% a year, and it takes 2 years to build an office, you may decide to go ahead and purchase 2 years worth of steel now to save money in terms of the price going up. The problem is if we go into a recession and then there's no demand for your office space, then you're stuck with that 2-year inventory accumulation until we start to see the economy picking back up, demand for your office space, and then you start to buy from the steel companies again. So hopefully you see how that might cause a recession to be longer. Then it could lead to a recession if the Fed continues to raise interest rates. And I'll talk a little bit more about that in a minute. And then finally, it can spiral upward with wages rising and inflation expectations unanchored. So question for you, Heather, are you seeing a lot of pressure to raise wages at this point in time, especially for new workers?
We have, and it's kind of been an ongoing thing for the last few years. It's not quite as wild as it was. 2021 was for like the Wild West of hiring, it seemed like. But we are seeing it. It's not quite as critical of a situation as it had been, though.
Okay. All right, thanks. And that seems to be consistent with what the data are showing, and I'll show some wage data in just a minute. Now, some of you may be saying, what is a recession? There may be people on this webinar. And by the way, please continue to ask questions and put them in the chat, and we'll get to them at the end. And also, we'll make a copy of this slide deck and the video available for you sometime later this week. But in any case, recessions are normal. We see business cycles all the time. So these gray shaded areas are recessions. Some of you may not have been around, but for one of these recessions, perhaps the COVID recession, which was the worst that we had seen over this entire time period since the 1940s, employment dropped 14%. But since 1945, over this period, you're seeing employment on average drops about 3.9% from peak to trough. So that's from the peak to the bottom before we start to grow again. And if we consider 3.9% loss today in jobs, that would be about 6 million people losing their job in an economy where we are employing about 155 million people right now. So again, 3.9% drop would translate into 6 million losing their job. The smallest decline in a recession was back here in the 1980s. It was a 1.1% decline, and on average, recession typically lasts about 10 months. So if you lived through the COVID recession or you lived through the Great Recession, don't assume that what we saw back then will happen the same this time. It's always different based on the industries that are leading the recession. So why do we expect a recession? And the big reason is because we don't expect inflation to drop quickly. The Fed has said they're going to get the economy back to 2%. The economy does best, grows best at 2%. And so as a result, they're watching inflation very closely, and they're going to increase interest rates based on inflation. So you may recall 2 or 3 days ago, Chair Powell from the Fed spoke, and he underscored the idea that, hey, the latest numbers show the economy is stronger than we thought, employment is rising more than we thought, and as a result, we may have to raise interest rates higher than we had expected. So because of that, the stock market dropped off, and then this morning, at least last I checked, the stock market was growing, and we're in one of those weird environments where bad news is good news. The bad news that came out today was that initial unemployment claims rose more than expected. So the economy, the idea there is if the economy is not as strong as the Fed previously thought, then they won't have to raise interest rates as much as we thought they would have to raise rates. So that's why we say bad news right now is good news. Bad news means the Fed won't raise interest rates as much, so the recession might not be as bad. So when the Fed raises interest rates, it takes about 6 to 9 months or even a year to impact the economy. Higher home prices, capital expenditure prices. And so think about it, the Fed just started raising interest rates a year ago. So we are now just starting to feel the full impact of that increase on the economy. And then the other thing is the yield curve has inverted. So for those of you who aren't used to looking at the yield curve all the time, this is the Treasury curve, the 3-month bill, and then it goes on longer to the 5-year, the 10-year maturity, the 30-year maturity. And here's the interest rate you get for holding a 3-month bill a year ago was less than 0.1%. And then if you hold a 5-year, it's almost 2% that you get, and in a 10-year, a little closer to 2%. So you expect to have a higher interest rate if you hold a treasury for a longer period of time because there's greater risk. But the Federal Reserve has been pushing the federal funds rate up. That's not on this chart, but it's the only rate that banks use to lend each other. It's an overnight rate. And when the federal funds rate goes up, so does the 3-month bill and the 1-year here. And you can see right now that the 3-month yield is higher than the 10-year. And that's what we call an inverted yield curve. And whenever that has happened since the 1950s, we've ended up in a recession about a year later. The yield curve doesn't cause the recession, but it's a sign that a recession is coming. So at this point, we are expecting a mild recession. GDP below potential. Potential is 2% for the next 2 years, so something less than 2% real GDP growth. And then the unemployment rate, we expect to increase to about 5%. Heather, I think it was 2015 when we last saw a 5% unemployment rate. Can you give the audience a sense of how it felt at that time from a labor perspective, hiring perspective?
Yeah, it was still a really healthy market for the most part. We were able to find candidates to meet the jobs, but just like with everything, there are going to be nuances to where you sit, the industry that you're in, the level of the person that you're hiring, and you still have to think about all of the parts of making your offer attractive. It's just not quite as dire as it has been lately, but it's still a pretty healthy mix of open positions and people available.
Okay, great, thanks.
Yeah.
Good perspective on that. Um, so when we start to look at job postings, we start to see some slowing in the economy. And here, you don't post for a job unless you expect that your business is going to maintain growth. And so from that perspective, job postings are a leading indicator of employment overall. We have employment coming out tomorrow for February. It's expected to be about 220,000. That comes after a very strong growth of 500,000 in January. Some of that January strength may have been seasonality because around the U.S. We had warmer than typical weather. But in any case, we expect when we see that number tomorrow morning, it comes out at 8:30. It could be even less than the 220,000. If we look at our job postings here, you can see that once January, the end of January got here, job postings really dropped off, and they're off 17% since January. And this is for the U.S. overall. Note here some of the occupations that are in greatest demand on the nursing side, as well as computer information. One of the other things that we often see is that when we're moving toward a recession, or when employers like yourself are uncertain about the economy and whether your demand is going to hold up, sometimes it's easier to hire people from a staffing agency, because then if you have to lay someone off, it's not someone who's with you, it's someone who's only with you on a temporary basis. So have we seen anything from that perspective? Here we're looking at job postings in the U.S. from staffing firms only, and notice that yes, and we have started to see an increase where employers are starting to switch to, instead of hiring themselves, hiring some temporary workers. And again, this is a sign we've seen in the past with regard to potential recession. I should have noted earlier, the blue is this year's data, the gray is last year's data. So you can see that in this case, we saw increases in both. But on the previous slide, we saw the sharp drop off in this year's data. And last year at this time, we were actually seeing job postings growing. Also wanted to point out some of the in-demand occupations right now from staffing agencies. On the previous chart, we didn't see as much from the software computer related in the top 10, but certainly from a staffing perspective, we're seeing more of that hiring through agencies. And now something that Heather said she saw earlier, and that is wages are slowing a bit. When we look at, typically you're seeing wages increase maybe 2% year over year. Toward the end of 2019, 2020, we had a very strong economy, and typically when you have a strong economy, wage pressures will go up. Here, because of COVID, we saw some swings, and then we saw a high of 6%. So the implications of this for employers is this might be a good time to benchmark your expectations with the LHH salary guide. And Heather, I don't know if there are any other things that you have out there that would help employers right now benchmarking wages.
Yeah, definitely. I mean, we have our salary guide, and it's a really good starting point because we have a lot of really good data. Thanks to our team for that. But we also have our field of consultants. We have the folks like me who are out and living in the markets and studying them every single day. So we also have the ability of, reach out to us. We're not going to do the hard sell, but if you have questions about what's going on in a certain industry or with a certain position, we're all here to help with that and have a lot of data at our fingertips to help kind of steer that conversation and help our client partners make good business decisions.
Great. Thanks, Heather.
Yeah, thank you.
Mm-hmm. One other sign that the labor market is easing a little, and hopefully you as employers have seen this as well. This number came out yesterday. This is a survey that goes back to 2000. When we go into recessions and there's more uncertainty, people quit less. So they stay at your firm longer. They're afraid that if they quit and go to another firm and we go into a recession, they don't know how well that firm will do or if they would be let go since they were the last ones hired. So interesting here, we saw peak levels of people leaving their jobs. And now with the latest data, we're starting to see those numbers coming down. So less people quitting overall, again, a sign that the labor market is easing. And then initial unemployment claims. This has been somewhat surprising. Here's the latest number from this morning. You see an uptick, but it's been pretty flat. And we've heard about all these companies laying people off, and we're wondering, well, why is it not showing up in the numbers? It may be an implication for you that from the companies that they were laid off, they were given very good severance packages, and so they can wait for the right job to come along. So in any case, we are starting to see some uptick most recently, but initial claims have been low. And I guess, Heather, a question for you along those lines. Does LHH have any transitional services to help some of these clients who are laying off large numbers of people or even small numbers?
Yeah, we do. So our LHH Career Transitions and Mobility side of the house specializes in this. And so, you know, a lot of employers reach out to us to help with that kind of transition. One, because they care about their employees, much like giving them a severance package. But they also care about the optics around it. These are businesses who plan on staying in business long term. They plan on hiring again. And so they want to make sure that they are being responsible, but then also staying in the good favor of the public by engaging in organizations like us that help with, thank you, Kelly, for sharing it in the chat there, but helping to help their folks transition. So we have coaches, they even come into our internal database. And so our entire organization works really hard to get these folks back to work as quickly as possible.
Great. Thanks, Kelly. Yeah, that's an important important service for people that are out of jobs.
Yeah.
I'm glad you guys offer that. All right. Unemployment rate, if we look at it across the country, the darker areas are where the unemployment rate is highest, lighter where it's the lowest. So you can see the high-tech area up in Washington on the West Coast, we're seeing much higher unemployment rates with people being laid off. And then in the central part of the country, much lower unemployment rates where we're seeing more dependence on food industries, agriculture, and then some pockets of unemployment in some of the metropolitan areas that you can see here as well. So with that, I am going to turn this over to Patrick, and let me encourage you again to continue to put some questions in the chat or in the Q&A, and we'll be happy to get to those at the end.
All right, thanks, Chris. So we've taken a good look at the national trends. I want to dig a little bit deeper in this section into some information from online job ads and what that can tell us about some of the different impacts in industry and occupation. And indeed, we do see employer demand as measured by job ad volume is certainly trending down with some variation. We also are starting to see some interesting changes in the way that employers who are posting ads are framing the postings in response to the candidate pool. So some occupations are seeing some education requirements increase during a time of greater labor market slack. We saw a significant jump in remote and hybrid jobs being advertised throughout the pandemic, but that's beginning to drop off in some of the data from early this year. And overall, I think it's fair to say candidates have enjoyed heightened negotiating power over the last several years and a tight labor market. We're seeing some signs of slowing salary growth and sign-on bonuses, which again indicates some initial labor market slack in some areas. As Chris was was showing in some of those job ad charts, I've gone back to the first quarter of 2020 here to look at overall job ad volume. The number of postings steadily increased into about the middle of 2022. Some ups and downs, maybe some seasonal patterns here in the third and fourth quarter of each year declining. But overall, in 2022, we saw more than 5% increase in overall job ad volume. But the number of ads started slowing in the third quarter and continued into the fourth quarter and early into this year. Another indicator of how much difficulty employers may be facing in filling some of these jobs is not just the volume, but how long those ads are staying online. Greater number of days online indicates, assuming that employers remove the ad once the job has been filled, longer duration is an indication of greater difficulty hiring. And indeed, in the tighter market of 2020 and 2021, we saw 31 days, 41 days on average, the jobs were staying online. In 2022, the median duration dropped back down to about 32 days. This is showing some slackening and easing of hiring compared to 2021, but still is at a higher level compared to something pre-pandemic like 2019, where it was about 30 days on average. Heather, I wonder, is this something that you're seeing working with employers, or do you have any advice for employers on speeding up the hiring process?
Yeah, for sure. Thanks for asking, Patrick. One thing I'll say when I look at this, the first thing that I noticed is 2021, we were all dealing with filling jobs, net new jobs because the economy was doing well, but then also backfilling jobs of all the folks that were leaving. And so that one understandably is much higher. 30 days is still a long time, though, to have a role completely open, especially if the seat is completely empty and the work isn't getting done. So what we're seeing, even with all of this data, is you want to make a smart hire, you want to make a good hire, you want to get the right person in the seat, but the best candidates are still in high demand. And so everything that you can do to appropriately court and quickly court your best potential new employees is going to help you. So having a really tight and engaging candidate experience when they're going through the market, having a really clear understanding of, is this exactly the role that we need to fill? Is our job description in line? Is it updated? Are we making sure we're communicating with our candidates? Because maybe we didn't hire this whole group this time, but we'll need to hire them next time. And so I guess long way of saying, don't let the shortened amount of time make it feel like we can take our time and slow down and interview, 20 people for one role in 5 different rounds. You still need to be thoughtful. You still need to be quick because 30 days is still a good amount of time to have an open seat.
That's a great insight. Thank you. Yeah, as we're talking about throughout on some of the easing market conditions, it's always a good reminder that 2019 was a very tight labor market.
Yeah, it was still hard to hire. Yeah.
So I also took a look here at job ads by occupation groups. In particular, I focused on a lot of the LHH market areas here and professional services. So the chart here is indexed to March of 2022. So 100 here represents the level of job ads that were posted at that time, and the change since then is measured as a percentage change since then. So when something hits 90, for example, that's about a 10% decline in job postings. Interestingly, at the top in red, food preparation and serving, you see the return to restaurants and services that Chris was talking about earlier. throughout 2022 in a high volume of job ads, but that has started really dropping off at the tail end of the chart here in January, February. Maybe a sign of people cutting back on spending as the price pressure continues. And there are signs of a slowing economy, and people one of the easiest ways for households to cut spending is in going out to eat, for example. The largest declines in some of the professional workers are at the bottom of the chart here in office and administrative services and in transportation workers as well. Have really seen about a 30% decline in those industries. And then further variation towards the kind of middle of the pack here, we've got legal and accounting and finance and IT in bright blue there. IT has been getting a lot of particular focus lately with the layoffs, and we're starting to see that certainly in the decline at the end of last year and certainly early this year in slowdown of job postings. Heather, does this kind of match up with what you're seeing?
It does, yeah. And it's interesting. Some of the comments in the chat, I think, also line up with what we're seeing. But yeah, we've seen, I was pulling numbers just before, and our admin and like executive assistant, the demand for those roles have dropped year over year at least. We're seeing a lot more business in accounting and finance. We're seeing a lot more in legal, and we still have a really strong IT practice. I think it's interesting. So we have so many different pieces of business units underneath us. And so one of them is called Hired, and they are pretty much like a LinkedIn for the IT industry, for technical roles. And so while these large companies are doing layoffs, there's more layoffs in the tech space. We also saw a ton of hiring in that space over the last couple of years. And so some of this is reducing the bloat, but we're also having folks want to bring in more entry level or upskilling more of those technical roles. And so what we've seen is a bigger need for learning and development, upskilling. We have one of our one of our companies, one of our brands is a brand called General Assembly, and we're launching a recruit, train, deploy practice area. So we're training these entry level folks to come in and take some of these roles that are the kind of boots on the ground, and then sourcing our candidates that way. And someone that's also saying in the chat here, hiring a qualified senior accountant in Dallas is extremely competitive right now. I can attest to that. It is really, really difficult. We're seeing a bigger uptick in the roles that are kind of keeping companies safe, keeping them compliant. That's been a trend that we've seen grow significantly over the last couple of years. So that tracks big time, right, with IT, legal, and accounting and finance. But yeah, very much so. Admin roles are slowing. I don't honestly know why admin roles are slowing. During the pandemic, we could make the excuse was that everyone was remote and they didn't need them as much. But I think as organizations lean more into compliance and more tech forward hiring, we're going to see similar trends continue.
Oh, that's great. Thanks so much.
Mm-hmm.
Yeah, I want to dig a little bit more into some of the regional patterns in IT also. So we took a look at MSA level or metropolitan statistical areas for computer occupations and job postings here. So went back from February of this year versus February of last year, and a pre-COVID number in 2019. And out of the top 50 or so MSAs by the number of ads in occupation, in computer occupations, only very few, about 16 shown here, actually showed any growth in job ads year over year. A lot of this growth is kind of aligned with some of the areas with lower unemployment that Chris was showing on the unemployment map earlier. Seeing some interesting results in growth in places like Des Moines, Lansing, Indianapolis. I also want to point out that someplace like Washington, D.C., at the very bottom of the list here has about 0.5% year-over-year growth, which is about a little over 200 jobs for the area. But if you look at the number of ads, it's over 43, almost 44,000 ads. So even in some of the large metro areas, we're seeing more stagnant growth or slower number of computer ads being added here. Might not recognize many traditional tech centers on the growth page here, because I also broke out areas that are showing declines in ads. And here we find where you might expect, given some of the recently announced layoffs, Seattle, San Jose, San Francisco, Austin, showing up in the top 4 here with at least 30% declines in the number of job postings. Now, again, this is not directly related to employment numbers. This is a signal for future hiring. So it's easy to kind of tie this directly to the layoffs because they go hand in hand. But it's a signal if you're looking for where hiring and layoffs are headed. We're getting some strong signals from some of these tech markets that computer occupation hiring is expected to continue slowing, and they're not actively looking for as many candidates in those areas. And just to highlight some of the pre-COVID numbers, in many of these metros, the decline in job ads puts it below a pre-COVID level from 2019. So that's a pretty significant drop, wiping out a few years of growth there. In some of the markets, though, the levels are still above the 2019 levels. So in something like Atlanta, you're seeing 26% higher number of job ads compared to pre-COVID. That could be a signal of a more resilient hiring market for computer occupations in some of these areas. And we'll have to keep an eye out too. It could potentially indicate if companies in those areas have maybe overhired or added staff beyond what might have been needed in a pre-COVID environment that of future continued drawdowns. That there's still some room in some of those markets. Going back to some of the other indicators of differences in recruiting for some of these occupations. It's interesting, we've seen in past recessions and changes in labor market conditions that employers tend to increase education requirements during times when they can expect a larger candidate pool, and may loosen education requirements when they're having difficulty recruiting. So in some of those markets that we've seen declining more, so like office and administrative support and IT and engineering, where there's fewer ads, potentially more candidates per available ad, we are starting to see some increases in education requirements that are not quite showing up in something like accounting and finance or healthcare in terms of changing requirements. Heather, do you have anything that jumps out to you about education requirements and candidates?
Yeah, definitely. Well, I think I wasn't surprised to see the accounting and finance kind of had stayed the same, because that's been one of those roles that for a very long time, the majority of the folks in that workforce do have a 4-year degree. In IT and engineering, I think also makes sense. I think especially as IT and engineering roles are becoming more and more in demand and those roles are evolving. The one that surprises me honestly is the office and administrative support. I'm pro college, pro education, but I always pause with educational requirements, just thinking about it from a diversity standpoint. Like, are you reaching all of the best applicants for it? And always always encourage my clients to ask themselves is why do we need the degree? What about having a degree helps this person be, better set up for the role? Because, and the other part of it too is how likely am I going to be able to recruit and retain someone who just graduated? If it's an entry level role, are we paying enough to help them live and thrive also with their student loan debt? And so I think for some of these, I would encourage everyone to put a little bit of strategy and thought into it before you decide to make it a required thing and the why behind it, but not necessarily wildly surprising data.
Great. Yeah. And I think it's worth pointing out the axes on some of these where IT and engineering we're looking at about 50% or 48%. And as office and administrative support, it's only between 8 and 9%.
So still little bits amount of it. Yeah.
Yes. But it's still worth keeping an eye on there.
Mm-hmm.
Great insight. Thanks.
Yeah.
In other trends in online ads, remote work certainly took off during the pandemic. We're looking at a percentage of job ads that specifically mention remote work, and prior to the pandemic, it was between 1% and 2% in 2019. You can see it sharply rises over the course of 2020 and 2021 as remote work becomes more standard, as candidates begin requiring it or insisting on it, as companies adapted to the changing COVID policies. It only reached a high of about 6.5% by the second quarter of 2022, and has started dropping off a little bit in terms of mentioning remote work specifically in a job ad for different occupations. Now, you may look at the 6 or 7% and be kind of surprised that it's so low. This is again something that very much varies by industry and occupation. So on this slide, I've broken out the top 20 occupations with the highest percentage of remote job ads. And for it, you might notice the many of the occupations called out in blue have to do with IT and computing occupations. It helps to work in IT to find remote work and to have some college education, an associate's degree or bachelor's degree. And for many of these occupations, you can still expect to see candidates looking for remote opportunities. Interestingly, for some of the accounting and finance roles that we've talked about, you see actuaries and tax preparers also show up on this list.
Yeah.
Oh, did you have something on that?
Yeah, I was just going to say, I just find it interesting. It's like when we were hiring in the midst of the pandemic, it felt like everything was remote. And now it is very much, I don't want to say the opposite, but we're still seeing a big demand. I'd be curious to know what the other folks who are in the webinar are experiencing, but we still have a lot of people who expected a minimum hybrid work. But I find it interesting because in the middle of it, it felt like 80% of the world's jobs were remote. So it's interesting to see the numbers and see how much it's changed.
Yeah. And we've talked about slowing wage growth as well. That slower wage growth is still indicative of growing wages, though. And when we break it out in some of these occupations, you can see how closely it is linked to in-demand jobs. And so for these roles that you're having trouble finding candidates or filling those jobs, that wage pressure is still there and showing up in some of the job ads. We see some of the highest demand jobs here in healthcare and especially like medical and health services managers, as well as in some of those computer occupations, again, computer user support and computer and information systems managers. Heather, did you have any advice for employers on this kind of wage pressure?
Yeah, definitely. I think it's important to know your local market and to always benchmark your salaries. But then also be aware of like your local employment or your state employment laws. If you have some pay equity laws that have just come out, pay attention to those. But it's a lot of what we are seeing also. At this point, I mean, folks aren't ever going to want to go back and make less than they're making now. And so there's been a few years of wage growth. And for the most part, you will still get what you pay for. I know that's probably not the right thing to say, but you will, if you want someone who is higher skilled, who has more experience, you're going to have to pay for them. And I don't see that probably ever going away unless we go back to something like 08 level of a recession.
Mm-hmm. Yep. And one final data point here, we are seeing some additional signs of some kind of slackening of pressure on wage growth in several of these occupations. Here we've got ads that mention sign-on bonus. And this is more common in several blue-collar occupations, especially something like heavy and tractor-trailer truck drivers. You'll see more ads with sign-on bonuses. And that's really dropped off throughout 2022. We've also seen kind of a leveling off or decline for service sector and white collar jobs as well in ads that mention additional perks like sign-on bonuses.
Thanks, Patrick. Back to Chris here for some conclusions. So we're not in a recession yet, but we still do expect one in the second half of this year. We don't expect it to be a deep recession or the unemployment rate to skyrocket. Again, this is all dependent on how much inflation comes down and how much the Fed increases interest rates. But given the expectation that they increase rates to about 5.5%, we don't expect the unemployment rate to really move up rapidly. Considering lower skill requirements for jobs, still hard to fill. So again, for those jobs that are hard to fill, you may consider lowering the skill requirements for them. But then again, as we just heard from Heather, you kind of get what you pay for in that respect. Expect the labor market conditions to ease further. Job ads, as Patrick has shown, are online fewer days. We've seen a slowdown in salary growth and sign-on bonuses. And in terms of some employees, yes, they still favor remote work, but I'd say that they prefer a job over unemployment if that was their choice, not being able to find a job that was fully remote. So with that, I'm going to hand it over to Kevin Miller, who's been in the background. He's our VP of Marketing and Sales, and I believe he will be sending us some questions. So,
yeah, thanks, Chris. Yeah, I've been kind of keeping an eye on the chat and throwing things over into the Q&A. So I'll just go through some of these and have two questions that are actually somewhat related, at least topically related. So I'll just ask both of these and just kind of open it up to y'all for discussion. Question, so do we anticipate seeing layoffs slow in the near future? And then kind of almost related to that, we had an announcement today by GM where they were announcing attrition efforts for most of their US staff. Is that something that we might expect competitors or similar companies to do in the future? So kind of along those lines, are we going to see more efforts like that, or are we going to see layoffs begin to slow like we've been seeing so much in the tech sector happening lately?
Yeah, so I'll start there. And layoffs, I would not expect to slow. I'd expect them to accelerate. And there was a good article in the Wall Street Journal this morning on the front page. The headline was "Lavish Workplace Perks Vanish as Companies Tighten Belts." So, for example, Meta is ending their free laundry and dry cleaning services. Twilio is slashing the employee allowance for spending on wellness and books, and they went through several other companies that are, firing the baristas who were at the office. And one of the other points the article made is that typically you'll see these tech companies or any company slashing benefits or perks before they start to lay off people. And so again, another sign that we're we're most likely going to continue to see layoffs increase. And then with GM, the same as well. It's interesting how oftentimes when you have one large firm in a particular industry make a layoff or an announcement about attrition, that it sort of opens up the gates for other industries to do the same. Because I was in banking for many years. If one large bank lays off, then it gives other regional banks some cover, you know, to lay off some individuals at their bank. So I think that's sort of a ripple effect that we see industry wide. And I don't know, Heather, if there's anything that you would like to add to that.
Yeah, I think we're anticipating a lot of the same. We're anticipating companies to be more selective with their direct hire. We're anticipating more layoffs, but at the same time, more companies bringing on like temporary support to just get the job done, or if there's like a special project or something like that. So yeah, I would agree with you for sure.
I would also add the attrition at GM reminds me of an article I saw a few days ago. I think it was also in the Wall Street Journal about companies changing policies on things like remote work or where jobs are located or what role a role might entail, with the expectation that a certain percentage of the workers may not want to work under those conditions and may seek other employment. So it wouldn't necessarily show up as a layoff, but we may see some additional job losses from those kinds of policies.
Thanks. And I will say, just looking at the chat, there are a number of links in there that are, actually from the attendees themselves. There's some good stuff related to apprenticeships, some presentations on remote work, things like that. So as y'all are kind of listening to us, there's some good links, some good stuff in there. Chris, a question, kind of diving into some theories in economics. One question that I saw here is, why does the Fed set 2% as a target for inflation?
Okay.
And could raising that target be helpful by
Mhm.
kind of making the Fed a little less obsessed with the rate increases?
Right. That's a good question. But before I answer that, let me correct, or at least I looked at the stock markets. It's down 300 points now. It was up this morning because of the slowdown in the economy, that is initial unemployment claims rising. But there were some banks that have announced issues with their revenues, and that's caused some of the market to go down, as well as apparently some people think that the market or investors are thinking about the ADP report that came out was strong, and the JOLTS data was strong yesterday, and so they're selling off ahead of the release of the labor market data tomorrow morning, which will move markets depending on whether it's stronger than expected or weaker. But back to the Fed. So that's a good question. Greenspan used to like to say that I like to keep we target an inflation rate that's so low that it doesn't come into play when you're making a decision to make an investment. So, so some people have said, yes, maybe they should only bring it down to 3%, but since the 1980s, there have been, I would say, hundreds of studies done by economists across the globe, and the finding is that an inflation rate around 2% is what will lead to strong economic growth going forward. So that's the rate that the Fed has targeted. If it were 3%, I mean, some people have argued for that, but I think based on all the research that was done in the past, 3% I think would put a different motivation in the economy than getting it back down to 2%. With 3%, I think you still have some people that will be hedging because inflation is larger, rather than making the best decision in terms of an investment, which would be best for the overall growth of the economy. I hope that was helpful. If not, and if you work with us, either Jobseeker or consulting, get with your account manager and ask them to get my email, and we could talk offline.
That's great, Chris. We're just a couple minutes left here, so probably time for another question or two. Are we seeing companies further lean into upskilling and development solutions in the absence of additional hiring efforts?
I can take this one, and the answer is yes. We've seen, so we have a learning and development arm underneath LHH, and then we also have an enterprise all digital version called Ezra. And so the demand in that area has increased significantly, but another part of our world is studying these kinds of trends. And so even the need for hiring in-house learning and development specialists or learning and development consultants, it's handy for a lot of fronts. And I saw someone else in the chat also saying that they were shifting people around to other areas. I love that. I think it's amazing. So it's a great retention tool. We are seeing more people do that, more organizations do that. Me personally, I think it's like such a lovely and smart business decision. I wish even more places were doing it. But it's a really, really smart way to retain and to get more out of your existing headcount. Because I think as organizations, that's what all of our for-profit ones want to do, is we want to make sure and help our people to be as productive as possible. And it's a great way to do that. If you can't hire, if you don't have the headcount, you can't or don't want to bring in temporary support. It's a brilliant way to do it. And it's a really smart way to lower your quit rate.
Yeah, I think that's great. We're running pretty close to time here, so I think we'll probably just stop there with the questions. Chris, did you want to sign us off here?
Sure. One question for you, though, Kevin. There's a lot of great, as you said, links that the audience has been posting. Is there a way for you to pull those links out of the chat?
Yeah, I'm thinking we can probably just add in the slides that we'll share around and have on our website. We can just go ahead and add something at the end to these slides that just have some of these links, which would probably be helpful to everybody.
Good. Well, thank you. Well, perfect. Thank you, everyone, for attending today. We appreciate your time, and thank you especially, Heather, for joining us with LHH. And we wish you all the best as we transition through this economy that appears to be slowing. Thank you.